Hello everyone, Namaste and welcome back. Today we'll be discussing very important topic which is contingent assets, contingent liability and provision. This topic is extremely technical but yet it is easy one. Okay. In this topic our objective is to find out what assets and what liabilities called contingent assets and how they are disclosed in financial statement together with what is the meaning of provision and how the provision is recognized in the books of accounts and how it is presented in the financial statement of an entity. Okay, so let's start with contingent assets, contingent liability together. I'll just try to prepare some charts here. Contingencies. Okay. So contingencies, we have two types of contingencies, right? What are they? Contingent assets and contingent liabilities. Correct? So what are they? What is contingent assets and what is contingent liability? Contingent asset basically refers to possible assets. Possible assets, okay? That means these assets are not there in the organization, but there can be some assets in future, okay? But these possible assets are happening or can happen because of some past event, and the inflow of this economic benefit or these assets is depending upon some uncertain events that are going to happen or will not happen in future. So arising of these assets depends on happening or non-happening of future uncertain event. Okay, let's go ortho here. What is the meaning of this? So there are three things that we need to understand here. One is there should be some past event. Some activity must have happened in the past. Okay. And at present, today, we are thinking that there is some possibility of inflow of economic benefit. There is some possibility of arising an asset. So we are thinking that there is some possible event, possible asset. When we are thinking about this, we are thinking about this at current time, today. Okay, current time, on the date of balance sheet. Okay, balance sheet date is called current date while discussing a provision or any assets or liability. Okay, so this is current date or current time, but this asset will arise in future. This has not yet arose, but it will arise in future. Okay, so it depends upon future contingent event. Now, what is the feature of this contingent event? This contingent event is uncertain, first thing. Second thing is it is uncertain. That means it may happen or it may not happen. Second thing is it is not in the control of entity, not in control of entity. Okay, so both, it should be uncertain, and that its certainty, uncertainty, whatever it is, should not be in the control of entity. Okay, maybe in the control of some other entity, but not us, the entity which is preparing the balance sheet. Okay, So it can be in the control of some other persons, wish of some other persons, but not in the control of a person which is preparing the balance sheet. Okay. Okay, then let's talk about some example. Okay. Say an entity XYZ company file a case. Okay, a case claiming an infringement of its patent. That means, suppose XYZ company has developed its patent, certain technical formulas and something like that, or invented something, and some other entity are seen to copy that invention without having the right to do that. So in that case, XYZ company went to court and filed a case against that another company which is copying that invention, or which is following that invention, using that invention. Now I want compensation for that. XYZ company wants compensation for that. XYZ company is claiming that this was our invention which is being used by that person. Okay. Now there is a chance that the court may award the compensation, or court may not award the compensation, depending upon how factful was the case and how truth was the claim of XYZ company, right? Okay. So court's decision to award compensation What is this? Is this future event? Yes or no? Yes. It is certain or not? It is not certain, because court may or may not award the compensation. Now the third thing is it possible that we can win the case? It must be possible in order to say that this is our possible future inflow of economic benefit. Okay. So when this becomes our contingent assets, this will become our contingent asset when there is a chance up to 50% that we are going to win this case. Up to 50% chance that we are going to win this case, then this is contingent asset. This chance of winning up to 50% is known as possible winnings or possible asset. Okay. So what is possibility? Possibility is chance, and chance should be up to 50%, right? Okay. When it is up to 50%, it is called possible asset. It is called possible asset. Got it? So whenever there are some possible assets that may arise in future because of our past activity. What is the past event? The past event is we have already invented it, right? Past event is we have already invented it, and someone is infringing. Infringing means violating a certain law, copyright law or trademark related, patent related, registration related law. Okay, so someone is infringing that. That is the past event, and because of that past event, we have gone to court and we are claiming for the amount. Because it is only 50% chance, or there is only 50% possibility to get the reward, or less than that possibility, we are calling it contingent asset. Okay. Now, first of all, you should pause the video and copy this definition and all. I'm not going through the definition, I'm just trying to give you certain understanding of these terms only. Okay, you should go through the definition. Possible means a chance up to 50%, that is written here. Okay, and how it is treated, I'll definitely talk about it. Let's go to the contingent liability. Contingent liability, there are two ways of identifying contingent liability. Contingent liability, there are two ways of identifying contingent liability. One way is similar to the contingent asset, which is past may there should be some event, past event, and because of this past event there is possible liability at present, from which we are expecting outflow of economic benefit in future, which is uncertain outflow. Uncertain outflow. Okay, uncertain outflow. Now, what is possible liability? That the outflow, the chance of outflow is up to 50%. Okay, this is possible liability. Okay, now because of past event there is some possible liability for which we are going to have outflow of economic benefit in future, the chance of which is up to 50%. This is one definition of contingent liability. Okay, for example, let's say just like in this case where we have filed the case against certain entity which are infringing our inventions or our patents. Similarly, somebody else can come to us and ask for certain claim, like warranty claims. We provide warranty for certain product and the other party is asking for that warranty. Now, how much is the chance of asking that warranty? There may be very minuscule chance. There may be a chance of less than 50%. Then in that case it becomes our contingent liability, because we have made some commitments that we are going to provide you certain warranty, and the chance of asking that warranty, or chance of a person asking for the warranty winning the case, is less than 50% or up to 50%. Then in that case it is also contingent liability. Okay. There are other situations where we have already discussed about the contingent liability, like when you give guarantee, to bank, okay, at the time when bank is providing loan to the principal debtor, to protect the risk, okay, to protect from the risk that the principal debtor will not be able to pay back to the bank. In this situation, you are going to give the guarantee to the bank just to provide the loan to the principal debtor, and in case something happens, then I am going to pay back to you, right? If the debtor are good, there is very less chance that this is going to happen. However, there is still a chance. Okay, if the chance is up to 50% that you are going to pay for the default of the debtors, it is your contingent liability. So again, bank guarantee is a contingent liability. We will treat this guarantee as contingent liability. Okay. Similarly, we have also seen the case of discounted bill. Discounted bill. Okay. What is that? You are the holder of the bill, and goes to bank, discounts the bill, but who is primarily responsible for this bill? The acceptor of that bill, the person, the promisor of that bill is primarily responsible to make the payment against that bill, right? But what if the acceptor of the bill, the person who is primarily responsible, does not pay to the bank? What will happen? In that situation, the person who has discounted the bill has to make the payment back to the bank. So there is a chance that you may be responsible for the bill when it is dishonored by the party who is the promisor of the bill. Okay, so there is still a chance to shift the liability towards a person who has discounted the bill. Hence, for that person who has discounted the bill or discounter of the bill has a contingent liability against that discounted bill. Got it? Okay. There is a chance that he may pay in future, but that future is uncertain. Maybe or may not be. Now there is another thing. This is about the present obligation. This is very crucial. Listen carefully. Present obligation. That means it is a liability already. It is already a liability. It is already a liability. Okay, arising out of the past event. But amount cannot be reliably estimated. That means there is very less information about the calculation of the amount, or we cannot estimate the amount to some substantial degree. What is substantial degree? Maybe 90-95% accuracy. We cannot do so. We cannot measure it because of lack of information. In that case, even a present obligation will also be treated as contingent liability. Even a present liability will also be treated as contingent liability, because we cannot assume or we cannot estimate the amount. There is no reliable estimation of the amount. So the amount should be able to be reliably estimated to become a present obligation. Okay, if you cannot reliably estimate it, it does not become the present obligation. It just will be continue as contingent liability in the books of accounts. Okay, so even the liability is present obligation, it will be called contingent liability if the amount cannot be reliably estimated. One thing is that, and similarly another thing is, it is again, it is present obligation, it is a present liability, present obligation plus, however, present obligation is there, but there is there is less than 50% chance that there will be economic outflow or outflow of economic benefit. Chance of outflow of economic benefit is up to 50% only. Then in this case also we can call it contingent liability. For example, suppose there is a change in law which says that all the trainee which are at manager's level, all the employee at manager's level should be trained for certain part of this law. Okay, there is some law, let's say some tax law, and the government is asking that every organization should train their managers, about the tax law of that country or particular country. Okay, now for training you must spend certain amount, right? Okay, for training you must spend certain amount. Okay, so what is the chance that the manager are going to appear in that training, or manager are going to quit the organization? Maybe it depends upon situation to situation. Maybe manager will not want to get the training of tax related laws. Maybe the organization is trying to decide to close or shut down its business. So in that case, organization can avoid the liability, which is present obligation, but it can avoid the liability. In this situation also it is contingent liability. Maybe you may do so, or maybe you may not do so. It depends upon your choice. And there is less chance that, there is less than 50% chance that you may enter into that obligation, or you may go for the training. Then in that situation also you can call it contingent liability. Another example of contingent liabilities which is very prominent, which is very popular, is case related situation, where somebody has filed a case against your organization, and it is a chance that you may have to pay certain amount when you lose the case. Then if there is only 40 or 50% chance or below that chance, still there is a contingent liability that you may pay for certain compensations or damage to the other party who is claiming against your entity. Okay, in that situation also we have contingent liability. So though this one is very technical, it should be discussed in cap 2. I'm not sure why it is given in cap 1 level, but you can copy this contingent liability wala part here, which is there. The definition is very easy. I know that all the students are, instead of understanding the contingent liability, are going to mug up these provisions and just appear in examination, but please don't try to do that. Understanding contingent liability is very easy. It is contingent and it is liability. Contingent means it is uncertain and it does not depend upon our control. Liability means liability is actually uncertain and it may arise in future. That is contingent liability. That is simple basic definition of contingent liability. Now other things are very technical about it. Maybe there is a present obligation but no reliable estimate is contingent liability. There is a present obligation but no probability, no probable outflow of the economic resources is contingent liability. So there are other technical definitions that are given there, but we are not going to deep dive into them. I have just superficially touched upon it, but just keep it in mind that contingent liability are those liability which arise in future, and those are arising because of past event, and at the time of preparing balance sheet we are thinking that this may arise in future, and hence we are going to disclose them in our financial statements. Okay, especially in the section of notes to account. They are not recognized. I'm going to tell you the treatment of the contingent assets and contingent liability. Previously, contingent assets and contingent liability has two different treatments. Contingent assets was not even shown in the notes to account or disclosed in the notes to account section of financial statement. But nowadays, both contingent assets and contingent liabilities are disclosed as notes to account in the notes to account section of financial statement as per IAS, International Accounting Standard 37. Okay, the number is IAS 37. This requires the disclosure of both contingent assets and contingent liability, but there are certain situations about it. However, initially it was not like that. There were no surprise that in certain situations we may see that contingent assets are not even disclosed anywhere. We can see such kind of provision, so you don't need to be surprised about that. That was the earlier provision even before the International Accounting Standard was there. Okay. So now let's move to the very important part of this lecture, which is provision. Okay, the provision is very important one. And this is very simple also. What is provision? Provision. Provision is nothing, it's just a liability. Okay, it is estimation of expense, it is a liability. Okay, so we have certain definition given here. I'll make you go through this definition and then I'll try to explain what is that. Provision is a liability which is measured by using the substantial degree of estimation. First thing, provision is nothing, it's a liability. Okay, it is a liability which is measured by substantial degree of estimation. Can you see this thing? Substantial degree of estimation. It is a liability which is estimated. First thing is it is liability which is estimated. It is not for sure. It is not for sure. It is certainly fixed. There is no fixation of the amount. It is just estimated. Prime focus should be on the estimation. So when a liability is estimated, it is provision. Simple. In plain language, when liability is estimated, it is provision. When liability is certain and fixed, it is liability. If it has to be estimated, then it is become it will be called provision. Now, what is substantial degree? Substantial itself means to some extent, to a bigger extent, okay, a certain degree, okay. So substantial means more than the degree of ignorance, that is substantial. You cannot ignore it, then it becomes the substantial. And then technically it will be 90 to 95% accuracy. When you can accurately measure 90 to 95%, nowhere it is written like that, but practically it happens like 80 to 85% or 80 to 95% accuracy on the estimation of certain amount will be a substantial degree, depending upon type of expenses which we are trying to recognize, or type of liability which we are trying to estimate, okay. So but not fixed कि इतने हुनु पर्छ भन्ने छैन, but 80, 90, 95% accurate estimation or accuracy of estimation will be substantial degree that will suffice for calculation of certain liability, okay. If it cannot be measured substantially, it will become contingent liability. That is the definition, another definition of contingent liability. So I am putting three different conditions which should be fulfilled in order to be a provision. If all these three conditions are fulfilled, it will be a provision. If not, it will not be a provision. First condition is there should be present obligation. There should be present obligation arising out of past event. Okay, arising out of past event. Second one, outflow of economic benefit is probable. This is very important. Till we are discussing the contingent assets and contingent liability, I was using the word possible. Possible means up to 50%, and now I am using the word probable. This is higher possibility, okay. It is more than 50% chance. More than 50% chance means it is not yet certain, but there is higher chance of outflow of economic resource. Higher chance, that means more than 50% chance that there is outflow of economic resource going to happen, okay. Third, this was the last one. Third, there is some reliable estimation of amount. This is called substantial degree, okay. Reliable estimation of amount. You can estimate the amount and you can rely on that, okay. Like almost accurate, not accurate, but almost accurate, approximation, okay. So if all these three conditions are going to be fulfilled, then you can call it a provision. So provision is nothing, it's a liability. It is a present obligation. You can directly call it like outstanding or payable or something like that, but it is a liability for which the amount is reliably estimated, and the outflow because of this liability is not 100%. The outflow is more than 50%, okay. It is not 100%. If it is 100%, then definitely it is a proper liability. It is not a provision, but it is the outflow of economic benefit because of this obligation is not 100%. It should be below 100%, but more than 50%, okay. Then only we'll call it provision, okay. So provision can be made for many things, like it can be made for some expenses, it can be made for some losses, it can be made for some other commitments, even for warranties. If there is more than 50% chance that the certain amount of certain amount of obligation is always involved every year, then we'll not call it contingent, we'll call it a provision. Okay, because let's say there is a company called MI or Xiaomi is going to replace the parts of lots of mobile every year because of its warranty provision, right? So when it has already given warranty and it knows that some lakhs of crores of rupees are always used to replace the parts of some damaged mobile phones after selling them, and it is so sure that this is going to happen every year for certain level of amount, certain degree of estimation. Like it can, in Nepal it can estimate like 5 to 6 crores per year are always spent on replacement of certain worn out parts of damaged stocks. Okay, if it is happening every year, we know that this is going to happen. Okay, if it is going to happen, then why not call it a liability? The same thing will going to happen in the next year, right? We are not sure, we are not saying it 100%, but you can call that the certain amount, this 5 crore or 6 crore rupees is going to be spent in the next year also. And why we are going to spend this next year? Because we have made the sales this year. If we have made the sales this year, people are going to come back to you because some goods will be damaged, and in that case you have to replace the worn out part of those mobile set which you have sold, right? Because of current year's sales and current year your commitment of warranty, next year certain people are going to come back to you and asking for the damages. In this case, because you know that people will come, you cannot call it contingent liability, you will have to call it provision, because you know the people, certain amount of people will come, they will ask for the damage, but how much you do not know. You are just making approximate estimation. Because you are making estimation, you will call it provision. You will call it provision because you are making estimation. You are not sure how much, but you are so sure that people will ask. That means you have the obligation, but you do not know about the amount clearly, but you can estimate. If you cannot estimate, then it will become something else. Okay, you cannot have a substantial degree of estimation, it will become contingent liability rather than provision. But if you have substantial degree of estimation, you can almost 90-95% accurately estimate the liability, then in that case we have to call it provision. I hope you are understanding this part. Now, all these three conditions: first, present obligation because of past event, and there should be certain sales and commitment of warranty. Okay, or there should be certain some employees working in your organizations and they have met an accident. Now you have to pay for the health care of those employees. Okay, that is a past event that has happened. The accident had happened. That person was your employee. Okay, there is a chance of bad debt that can happen. Bad debt provision, we know this, right? There is a chance of bad debt that can happen. What is the past event? The past event is we have made the sales on credit. Because of that, there is a chance that you may suffer certain bad debts. Then you have to estimate on the basis of your experience कि past मा कति bad debt भएको थियो, हैन? त्यसैको आधारमा एउटा एस्टिमेट गरेर क्याल्कुलेट गरेर त्यो एक्सपेन्स त्यो लसको लागि हामीले एउटा लायबिलिटी क्रिएट गर्नु पर्यो कि फ्युचरमा पनि यस्तै लस हुन सक्छ, फ्युचरमा त्यो एक्सपेन्सहरु हुन सक्छ हैन, हुन सक्छ भन्यो भने अझ there is less than 50% जस्तो देखिन्छ, फ्युचरमा पनि यो हुन्छ हैन, and the chance is more than 50% chance कि हुने नै वाला छ bad debt. Now why not we shall create, because we have made the sale this year, that's why it is going to happen next year, na? That's why this is current year's obligation, and because of this obligation we have to sacrifice our economic benefit. That's why it is called provision. Okay, now there are lot of other technical things that are there to be discussed, but I don't want to go through all of them technically, but I want you to write this note for you. There is a definition. A provision is a liability which can be measured only by using substantial degree of estimation first, and there are these three conditions given there. The enterprise has present obligation as a result of past event, and it is probable, there is more than 50% chance that there should be outflow of economic resources or outflow of resources embodied, that means having economic benefits, which will require to settle the obligation. Obligation के लिए we have to give the economic benefits or assets of the organization. And third condition is we can reliably estimate the amount of the obligation. We can reliably estimate. Okay. If these three conditions are met, then it is a provision. If these three conditions are not met, it is not a provision. How provision is recognized? Generally, there are multiple ways of recognizing provision. Generally, we can recognize provision as if we have booked an expenses and liability for that expense. Okay, and when expenses is booked, P&L is debited. Hence, we will debit P&L account and will credit a liability called provision for such expense or provision for such liability. Okay. There are situations where we have to create provisions like provision for the warranty, provision for tax, because we have to estimate, we have to pay tax, but we don't know the exact amount. That's why it is called provision. Provision for bad debt, we know that we are going to suffer, but we don't know the exact amount. That's why it is called provision. Provision for depreciation, we don't know exactly how much should be the depreciation. That's why it is called provision for depreciation. Pension liabilities, maybe there are chances that you have to pay for the retirement benefits to the employee. Hence, how much you don't know it. That's why it is called provision. So provision, when accuracy is not available, then it will become the provision. Accuracy regarding lot of things. Accuracy regarding the chance of happening it. यदि 100% chance भयो पे गर्नु पर्ने र amount estimation पनि accurate भयो भने, if there is a 100% chance of making the payment and the amount of estimation is accurate, then it is definitely not provision. It should be a pure form of liability, outstanding liability or payable liability. Now the thing is, what if all these three conditions are not fulfilled, or any of these three conditions are not fulfilled? If any of these three conditions are not fulfilled, then in that case the obligation will become contingent liability rather than provision. Suppose if the obligation is if the obligation is not present obligation, it may arise in future, then it is contingent liability. If the obligation is present obligation but the chance is less than 50%, it is contingent liability. If the obligation is present obligation, chance is more than 50%, but it cannot be reliably estimated, then it is also again provision. However, you should be very careful that if there is a remote liability, there is one condition there, one situation called remote liability. What is remote liability? Remote liability is where a chance of up to 50%, up to 5%, 5%. When there is a chance of outflow of economic benefit up to 5%, it is called remote liability. We will ignore this liability. Neither it is disclosed in the as a footnote or in the books or as notes to account, nor it will be recognized as certain liability or certain expenses. Okay, so we'll ignore remote liability. Remote liability is nowhere disclosed, nowhere recognized or recorded. Nowhere disclosed, nowhere recognized or recorded. Now about the provision and contingent liability. Contingent liability, it is not recorded. It is not recorded. It is not recorded, but provision, it is recorded. What is the difference between that? What is the difference between these two? Contingent liability is not recorded. That means no journal entry. No journal entry. Provision, there is proper journal entry. As I have already shown you there, P&L account debit to provision. Now disclosure, there is no recognition, but there should be certain disclosure. Disclosure as footnote to balance sheet, as liability on balance sheet. ये जो प्रोविजन से एज लायबिलिटी ऑन बैलेंस शीट, प्रोविजन कैसे दिखेगा, एज लायबिलिटी ऑन द बैलेंस शीट, on liability side of the balance sheet. But contingent asset liabilities are not even recorded. If they are not recorded, they cannot appear in the face of balance sheet. They will not appear because you are not recording them. But you can disclose them by writing additional notes. Okay, we can have a liability of so much, so amount because of this activity that have happened, but the chance of less than 50%, hence, or up to 50%, hence we are not recognizing them. We are showing them or disclosing them as contingent liability in our notes to account or notes to account section of our financial statement. ऐसा करके लिखने का. Okay. So this is the treatment of contingent liability and contingent provision. But what about contingent assets? Contingent assets. Prudence principle क्या कहता है? What is prudence principle called? Prudence principle will say कि please, you don't even need to disclose it. You don't even need to disclose it. इसका मतलब रिकॉग्निशन तो बहुत दूर की बात है. रिकॉग्निशन तो बहुत दूर की बात. We don't need to talk about contingent assets. But nowadays the things have changed. People are talking about contingent assets. People try to, show these contingent assets in the books of, in the financial statement as a note in the note section of financial statement. Okay, because of IAS 37, which is the recent one, International Accounting Standard 37, which talks about the contingent assets, contingent liabilities, and provisions. Okay. This is all about contingent assets, contingent liability, and provision. Definitely we cannot go much more deep into it because of our constraint in time, but I have tried to touch almost all the understanding that is there in the contingent assets, contingent liability, and provision. There is a difference between provision and contingent liability given in this section. You can copy this. Okay. Now there is no light. Okay, guys, see you soon in the next lecture, where we'll discuss about the accounting standard, accounting estimates, and accounting policies, which is very important. Thank you, guys. Thank you so much. See you in the next lecture.